Hello, everyone. Welcome to this training program. In this training program, we will be learning about and understanding about fundamentals and essentials of Forex and comics market. Well, this training program will help you to understand about how Forex market works, what are the basics and some important aspects of Forex and comics market. So are you all ready? Shall we start? If you're all ready, give me a quick thumbs up and then we will be starting. Are you all ready? Okay. Well, let us start. Before I start and begin this program, I would want to introduce myself. Well, my name is Shubham Soni, and I am a dedicated finance enthusiast. I myself is a full-time trader and investor. I have about 7 year plus experience in financial markets, trading and investing. And today, I will be helping you in understanding that how Forex and comics market works. Well, let us start with the first and the very important thing, which is introduction about uh, 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 the topics that we will be learning today. So today we will be covering four topics. First, we will talk about the overview of financial markets. Second, we will talk about different important terminologies, which will help you to understand how these market works. Then we will understand about the market dynamics and a bonus thing. I will also be talking about um, different trading strategies that you can follow to understand that how these market works. So are we all ready? Yes, let us start with our first ever topic. Well, let us start with the first topic and understand that what exactly Forex is. Well, the word Forex is made up of two words, foreign exchange. And this basically means that trading in foreign currencies. Well, let us say that you want to transfer $1,000 to your friend living in United States from India, for example. Is it possible that you can transfer that money in INR, Indian National Rupees? No, that's not possible. You will have to convert your rupees to US dollar and then only you can transfer that money, right? Well, if you want to transfer your money from India to US, you will have to do foreign exchange. You will have to involve in trading. So you will either reach out to a bank or any other intermediary and you will say, hey, I have this $82,000 or 85,000 rupees. I want to transfer this money to my friend in US. They will convert that into US dollar and then you will have to transfer that. So what basically you're doing, you're trading your Indian rupees and you're buying US dollar, and then you are transferring. This is what foreign exchanges. Well, there are people, those who trade in foreign exchange, Forex market, they buy and then they sell in order to make profit. You know what is the good point about Forex market? The good point is that it is 24 by 5 active, which is a good thing even for full-time investors, plus even for people those who work, they're employed, they go to office, even they can trade during off office hours, right? Which is a very good thing. And this forex market is highly liquid. But why these currencies fluctuates? That's a very important question. Why? Well, there are a lot of factors: economic factors, geopolitical events, Fed, RBI, or different central banks, they release their data, the interest rates and all those things, which impacts the overall uh, financial market and then also the currency market. Geopolitical events like politics, like elections of major countries, um, any kind of a war, this also influenced the forex market. And what do traders do? With various strategies, they try to trade and try to make profit in this forex market, right? Let us also understand about what is comics. Well, comics is commodity exchange. So it is a division of CME, which is Chicago Mercantile Exchange. And in commodity exchange, you trade physical goods. You trade metals or natural gas, metals like gold, silver. So when you buy and sell these physical assets or physical goods, then that is commodity exchange. So buying and selling of various commodities, primarily metals, are traded, and this is what commodity exchange. This is known as commodity exchange, right? So now we will be talking about important market terminologies. Well, first, we will talk about currency pairs. Then we will understand that what is base currency, what is quote currency. We will understand about bid price, ask price, spread, PIP, which is very important, lot size. We will understand that what is leverage. We will also try to understand about margin. We will understand about what liquidity is and how it works. We will understand about hedging and swaps. So do not worry about all these difficult words. It's pretty easy. I'll try to explain this in a very, very easy way. Okay. So let us understand with the first thing, which is currency pair. See, when you trade in currency, when you trade in Forex, you trade in pairs. Okay. As I gave you example, if you want to transfer your money to your friend living in United States, you're trading your Indian rupees from with USD, which is US dollars, right? Just like this, whenever you want to trade in currencies, you will always have to trade in pairs. So if you see here, there are some major pairs like USD, Euros, JPY, and GBP. So these are major pairs. So if you're saying that USD, JPY, this means that you are trading in this pair, USD and JPY. Now here, USD is the base currency and JPY is the quote currency. Okay. Now there are major pairs which involve these currencies: United States dollar, European euros, Japanese yen, and Great Britain pound. There are minor pairs as well which do not have US dollar including in them. So let's say JB, Great Britain pound, and JPY, Japanese yen. This will be known as minor currency because no US dollar is involved in this pair, right? And there are some exotic currencies as well. Exotic currencies means currencies having one major currency, can be US dollar, and second, which is the quote currency, can be any emerging market or a smaller economy. So these are the currency pairs, right? Now let's talk about bid and ask price. So let me show you one small image to make you understand that how bid and ask price works. So bid is the price which buyers are willing to bid is a price where sellers are willing to sell at that rate. Let me just show you. I was just opening this, and I hope you can see this image here. So this is the bid price. Bid price means these are the rates on which sellers are willing to sell, and this is the ask price, which means that buyers are willing to buy. So bid price means sellers are willing to sell, and ask price means buyers are willing to buy. And you know what? The difference between these two is known as swaps. The difference between these two is known as spread and not swaps. Okay. So that's how bid and ask price basically works. Let me share back my main screen so that I can start with the same part. 1 second. So yes, that is bid and that is ask price. Bid is the price at which traders can sell a currency, and ask price is a trader can buy a currency. That is bid and ask price. And as I said, spread is the difference between the bid price and the ask price. So let's take an example. Imagine that you want to sell US dollar and you would want to sell this, just a hypothetical example, at 85. So this is the bid price, and somebody is willing to buy at 86. So this is the ask price. Now the difference between two, which is 1, this is known as spread. Does that make sense? I hope you're able to understand, right? Yes. So this is bid and ask price, and the difference between the bid and ask price is known as spread. Now let us understand about PIP, which is PIP. What is PIP? PIP is the smallest change in quoted currency, which is percentage in point. So when a currency moves, it moves in pips. If you can see here, and as an example, if the Euro USD moves from 1.1200 to 1.1201, this is a movement of 1 pip, which is a smallest exchange, right? See, when you say Indian rupees, the smallest exchange for Indian rupees is pesas, right? Let's say 10 rupees, 50 pesos. So 50 is the smallest unit. In Forex currencies, the smallest unit is pip, because there are a lot of currencies. How will you even track that how currencies are moving? So we have created this smallest exchange, which is known as pip, to understand that how market fluctuates and to understand the points. So if the currency is moving from 82.301 to 82.305, which means there's a movement of 4 pip. Does that make sense? So this 4 pip is the movement of this particular currency. So let's say you bought at 82.1 and you sold at 82.05. Well, you made a profit of 4 pips. So that is pip. Now let's understand the lot size, which is very important. So when you trade in currencies, you do not directly buy dollars. Let's say if you want to trade in US dollars and Japanese yen, you cannot say that I want to sell 1,000, I want to buy $100, I want to buy $500. You will always have to buy and sell in lots. So there are 3 types of lots: standard lot, currency lot, and currency mini lot, and currency micro. Well, standard lot is 1 lakh unit of the base price, and you always represent this as 1. So if you're placing an order, which we will understand that how to do that, if you're saying that I want to buy 1 lot of any currency, then you're basically buying 1 lakh units, right? And this is how you represent it. If you are trading in a mini lot, which is 10,000 unit, which means that you're saying that I want to buy 10,000 unit, and this is how you represent 0.1. Okay. And if you're saying I want to trade in micro lot, then you will write it like this: 0.01. This is micro lot. So micro lot represents 1,000 unit, mini lot represents 10,000 unit, and standard lot represents 1 lakh unit. Now, every time the market fluctuates, you will also get the profit of 1,000 units or 10,000 units or 1 lakh units, depending on that how much money you have invested. So basically, you trade currencies in lots. You trade you trade in Forex market with lots, right? Okay. Moving on to the next part, and now we will understand about the leverage and the margin. You know what is the best part of Forex, foreign exchange or Forex market? Is leverage. So what is leverage? Leverage means that your ability to take a large position with even a small capital, right? So let's say if you are having $100 and you want to take a leverage of 10x leverage, which means that you, even with $100, you can take a position of $1,000. That's leverage. So your broker provide you leverage from 10x to 100x. Some brokers also provide 200x, which is unlimited. So let's say if you have $10,000 and if you want to take 100x leverage, well, you know how much money you can trade with. This is the amount of money you can actually trade with, right? So, well, you can trade with 1 lakh US dollars. Well, even if you're making 5% or 10% profit, you will end up making a lot of money. So that's how leverage works. Your ability to trade a large position with the help of small amount. Why? Because your broker provide you leverage facility. And what is margin? Well, margin is this minimum amount that you should have to take that position, to take that leverage. So if you want to trade with $1,000 and you're taking a leverage of, let's say, 100x and you're trading with 1 lakh US dollars, then the minimum amount that you should have in your account is known as margin, right? But there's one very important thing that you need to take care, guys. The thing is that if you're using leverage, you need to understand that what is risk management, because proper risk management and proper self-control, you can blow up your account as well. And that's what we should be understanding, that leverage can be rewarding, but can also be very, very risky. Now let's talk about liquidity. Well, liquidity is how easily you can trade in that asset or in that currency. So if you're buying and placing a buy order, how easily that order executes, which means how much liquidity that currency has, how easily you can buy and sell that currency without affecting its price. Sometimes when you trade in currencies which are not having high liquidity, even if you want to sell, see, when you trade in currencies, you buy from a buyer, from a seller, and you sell to a buyer, right? What if you bought and if you want to sell, there are no buyers, which means there is no liquidity, right? Which means there's less liquidity. So you should always trade in currencies which are highly liquid. And major pairs are known as the highly liquid currencies. Let's understand about hedging. So let us say you're taking, let me explain you with an example. Let's say you're taking a long position. Now, what is a long position? Well, long position is when you're taking a trade where you think that the currency will go up and you will end up making profit. So this is your buying zone, this is your stop loss, and this is your target. And this is a long position. Well, you're taking a trade, but anything may happen. Your trade can turn up into negative as well, right? It can also go down. So when you take a small position against your opinion or against your trade, then that is known as hedging. So why do you do that? Well, you do it because if your trade fails, you will not be doing a big loss, right? This hedging position, which is opposite position of your trade, will save you from a big loss. Okay, this is what hedging, and that's why hedging is important, because when you take a trade with high volume, even a small fluctuation against your trade can give you a bad and a big loss. And that's why uh, traders always do hedge and always take hedge position as well. Let's talk about swaps. So when you trade in foreign currencies, um, and when you hold your trade for more than a year or more than a day or two, then you will have to pay interest or you will be getting interest. So swap is nothing but interest paid on your currency. Let me explain you this by in a very easy way. See, let us say you bought some US dollars and you gave your INR, right? Now, you know what? In US dollars, you get high interest. The currency is strong, and so you will get high interest. So, isn't it unfair to a person who gave you your US dollar and you gave his your Indian national rupees, which is INR, to him, and even without a fluctuation in a day or two, you will make some extra money. You know how? Because on US dollar you will get high interest, right, on yearly basis. So swap is your broker charging you the charge for holding your trade. So if you're holding your trade from more than 1 day, then your broker will be charging you some interest, and that is known as swap charge. Now, I hope this is all clear to you all. These were some important market terminologies. Now, we will be talking about market dynamics. Why these currencies moves, why there is a fluctuation in the Forex market. The first and the foremost thing is supply and demand. What is supply and demand? Supply is a place or is an area where buyers are willing to buy. I'm sorry, supply is an area where sellers are willing to sell, and demand is an area where buyers are willing to buy. So price always moves with the concept of supply and demand. So if you see the price is going up from this area, this is known as a demand area, which can also be covered as demand zone. Demand zone means where people are willing to buy. And this is a supply area, which is area where sellers are selling. So whenever price goes up to this area, sellers sell. So this is a supply area. What you should do as a trader is you should find supply areas and demand areas. You have to buy from demand area and sell on the supply area. This is how, and this is why price fluctuates. Second is the economic indicators. Economic indicators like GDP, for example, gross domestic product of a country is improving. Well, this means that the currency might also get strong, and this can influence to move. Employment rates, inflation of the country, interest cuts by the central banks. These all economic indicator um, influence the movement into foreign currencies or these currencies. Central bank policies, so Fed, which is Federal Reserve Bank of United States, or ECB, European Central Bank, these are the central banks of these currencies. And when these banks uh, launch their policies, either they change in interest or they cut interest or increase interest, because of all of this, the supply and demand changes, and that's why the currency exchanges, the currency fluctuates, and traders trade that volatility. Even the global events and news can fluctuate and help in the foreign currency fluctuation. So geopolitical events like elections in major countries, natural disasters like, well, COVID-19 was one of them, example, war, um, any kind of these geopolitical events and news can also impact the overall supply and demand. And that's why traders need to stay informed about these events so that they can use and take benefit of these sudden movements. Now, why people buy this and who buy and sell these currencies? Well, there are a lot of market participants. You and me, like retail investors, apart from us, there are hedge fund investors, those who also invest in Forex market, commercial banks, institutional investors. These are all market participants. Just like you and me, they also trade in these foreign Forex market. So this was about the market dynamics. I hope you understood how exactly this works. Now let us talk about different trading strategies. Well, I've given you four things here: range trading strategies, breakout trading, swing trading, scalping. Range trading is one of my favorite, where uh, you use a Bollinger Band and then you try to figure out that a range of the currency, and then you try to take a trade. Well, as I said, you find supply zone and demand zone. You buy from demand, sell from supply. So that is known as range trading. People also do breakout trading. Breakout trading is when a currency pair break breaks out from a channel. So if let's say this is a currency and then this is trading in a channel, and then suddenly a movement comes and then a breakout happens, people also trade this breakout. Swing trading, where people hold for let's say 1 or 2 days and then try to make the profit. Scalping is when traders take very quick scalping trades, which means for every small fluctuation, traders try to take a trade. So they buy here, they exit here as quickly as possible. They sell here and they buy here as quickly as possible. So scalping is quick and a short term, very short term trade in order to make profit. Um, Now let us understand about, so these were some different trading strategies. Now let us understand about the um, risk in the Forex exchange. What you should do is you should always try to preserve your capital. What is capital? The money that you need to trade, right? These markets are risky, but if you will learn properly, you can make good profit because these markets are highly liquid. But you should always work with a stop loss, which is cut your trades if you're in a loss, right? And this will help you to preserve your capital. You should always work on your position sizing, you know. So I told you and I explained you about lots, standard lots, mini lot, and the smallest, which is micro lot. You should not take over leverage position because it can blow your account. So preservation of your capital is very important. Always work on risk reward ratio. Now, what is risk reward ratio? Can anyone answer this? What is risk reward ratio? Well, risk reward ratio is when you're taking a trade, you're willing to lose this much, right? But you're willing to gain this much. So your reward is high, but your risk is less. So you should always aim for at least 1:2 or 1:3, which means you're willing to lose one, but you're willing to make two, right? You're willing to lose one or you're willing to make three. So this is risk reward ratio. In long term, if you will manage your risk reward ratio properly, then you will end up becoming a profitable trader. And let us also understand about the um, emotional control. So you should also be very much control in your emotions, right? And how will you control your emotions? By proper technique. So risk management always helps you to control your emotions. Risk reward ratio always helps you to control your emotions. You should have a strategy where you properly know that how and when you will buy and sell, what is your risk reward ratio, and if that entry and exit occurs, you have to take a trade. If there's a profit, you have to book the profit. If there's a loss, you have to accept the loss and then close the terminal. So emotional control is very, very important, or else you will involve into um, multiple trades and you will end up blowing your account. Overtrading is a big problem, and you can only be doing this with emotional control. And the last is the and foremost thing is consistency and discipline. So you should have proper consistency and discipline. You should have a plan, which we will be helping you out in with. And you should have a plan to ensure that what are your entry points, what are your exit points, and when target occurs, cut the trade. When the SL hits, you should exit the trade. So Forex market and commodity market is highly rewarding. It's highly liquid. Uh, But in order to become a trader, in order to understand these market, you should be you should have to understand these basic things, which I have explained today. We talked about the basics of forex and commodity exchange. We talked about different terminologies. We talked about market dynamics, and I also talked about different trading strategies and different methods of trading. I think you might have understand this. That is all for today, guys. If you have any questions, we can ask different questions. Thank you so much for your time.